With the elections drawing near, what's going to happen with my investments come November 4th? Will there be a market crash? In this episode of Investor Questions, we're going to be addressing that very question. Welcome to YCG, where we help your capital grow so you can achieve your financial goals. If that's something that interests you, then hit that subscribe button and the bell notification so that you don't miss a thing. I'm Will Kruger, CEO here at YCG. With the election drawing nearer and nearer, we're hearing more people be concerned about what they should do with their investments. Now, I'm not interested in dishing out political advice, but what I would like to talk about is what you should do with your investments and how you can best be prepared. The main concerns with the election is the uncertainty it creates. Who's going to win? Is the market going to crash? And with that uncertainty creates volatility. And volatility just feels bad. And it can cause us to make short-term decisions or trying to time the market, which could actually hurt us financially. The other uncertainty is that the other guy, whether you're a Republican or Democrat, the other guy could wreck the economy and hurt your investments. So let's look at the stock market, the S&P 500, from a historical standpoint. Going back to 1960 all the way to 2016, if you look at the S&P 500 in the election year itself, the average return for the S&P 500 since 1960 to 2016 has been about 6.8%. Not bad. The year after actually has been even better. The average return for the S&P 500 the year after the election has actually given you about a 9.1% return. Now, we don't put too much stock into these historical statistics. I think markets are different. They adapt. People drive markets, and there are always once-in-a-lifetime events that can dramatically change or provide new data or new consensus. So don't just rely on historical data. What I will say is that when it comes to elections and markets, it's incredibly unpredictable. Just take, for example, 2016 election. Conventional wisdom and consensus showed that Hillary Clinton would be the next president. The Trump victory was a surprise, and conventional wisdom actually said that the market would crash if Trump became president. Well, interesting to note that the day after the election results, pre-market trading showed that the market was going to be down significantly, like negative 5% or more. At the end of that trading day, the day after the election results, the market actually turned and it ended up positive, significantly so. So it goes to show, again, politics aside, it goes to show how incredibly difficult it is to predict what the markets will do and how they will react. I think the key thing to remember is that the uncertainty does not drive business value, and that what really matters is what you own in your portfolio. Time in the market beats timing the market. Of course, history can be a helpful guide, but we know that future outcomes could actually be very different. There are many risks that face us as investors, and the election is just one of them. I think what's critical to remember is that human innovation historically has what's been the primary motivator and driver for the growth that we have seen in the economy. And we believe that it will continue to be the case. And stocks have been one of the great beneficiaries of that human innovation. And in our opinion, will continue to be a great way to participate in that growth. I think what's key is investing in global champions that have enduring pricing power and long-term volume growth, that they also have very conservative balance sheets that are globally networked. This, in our opinion, is the best way to move forward with a disciplined strategy and to do well despite all the risks that face us in the near term here with the elections. Such a great question. Thanks for posting it. Provide your comments and additional questions below, and check out our other videos. We'll see you in the next one.